So thank you for getting your numbers in. I think I got almost everybody, I think 10 people who did not turn it in, but you still have time. So get the numbers in so you don't lose the 5 points. But everything you're going to see will reflect your numbers. You know how you have those disclaimers on emails that you get saying, I'm not responsible for any of this stuff here. So I've just taken your numbers. So if you screwed up and added an extra 0, I just left the extra 0 in because, So I'm going to show you what you found in this class and maybe show you how it's different from previous semesters and maybe whether there's any information in it. Over the weekend, though, I did write a couple of posts on banking. I don't know. I mean, I know you've had other things on your mind and you're reading the post is not in there. But if you do get a chance and you're interested in banking, Friday I posted about, what's a bank? How does it make money? Let's say I'm not a banking expert, so I went down to basics. How do banks make money? What separates good from bad banks? And yesterday I asked the follow-up question, which is what banks are good investments? Different questions, right? What makes for a good bank is not necessarily what makes for a good investment. A good bank at too high a price is a bad investment. A bad bank at a really low price is a good investment. And so if you get a chance sometime after you're done with the final exam, if you want to come back and read those, you're welcome to. So let's get the process rolling. We're going to, as I said, this is going to be about what you've turned in. And I'm going to use your presentation as kind of the lead into this class. So if you think back to the start of the class, I said there are 3 ways you can put a number on an asset. You can do an intrinsic valuation, where you estimate expected cash flows. And it sounds so sophisticated when you say estimate. But now that you've actually estimated numbers, it's a mix of guesswork and hope and prayer that goes in. Revenue growth, I don't know what it'll be. Let me make up a number, 27%. That sounds reasonable. Pricing, where you look at what other people pay for similar assets, and you can already see that similar is more in the eye of the beholder than anything else as you define what your comparables were. And once in a while, this option pricing approach, and the nice thing about it is it allows you to add a premium on your DCF value. That's why people like option models. And I'll let you pick your own companies. I really did not restrict you on what you could do. But if you go back to the core of what we were doing in intrinsic valuation, essentially, we were trying to estimate the value as a function of questions you ask about a company. It shows up as a model, as an equation, expected cash flows divided by the discount rate, but embedded in there are answers to questions like what are your cash flows from existing assets? That's where we always start, right? With the income statement, the statement of cash flows, the balance sheet. You're trying to say, what are the company's existing investments and what are the cash flows from those investments? The second big question that kind of rides in this process, what is the value added, destroyed, or destroyed by growth? Because growth by itself is not a good thing. Growth can be a good thing in pushing up revenues and earnings, but it requires reinvestment. It's in your cash flows. How risky is this company? Shows up in your discount rate. And when will your company become a mature company? Becomes a terminal value number. What I'd like you to take out of this class is a recognition. The next time you see an Excel spreadsheet in your DCF model, step back and say, what are the answers that the analyst is giving to these questions, and do I agree with those answers? And of course, in my version of the model, which I kind of forced on you, and I did it partly for my own purposes, it made my life easier because I wasn't checking 100 spreadsheets from scratch. There are 3 drivers of your cash flows. Your revenue growth that captured the growth part of your business model, a target operating margin that effectively captures how profitable your business model is, and a sales to capital ratio that captured how efficiently you delivered growth. And my argument is no matter how complicated your business model is with a non-financial service company, those 3 inputs should be able to give me my cash flows. I don't need CapEx, working capital, all those line items are kind of distractions. This is my end game. The risk in your operating cash flows gets captured in your cost of capital. You don't like betas, throw them away. I really don't care whether you use betas to get to a cost of equity, but risk needs to come into your discount rate. And remember, a discounted cash flow valuation is an exercise in valuing a going concern. What does that mean? I mean, you look at a discounted cash flow valuation, you estimate cash flows a year, next year, 2 years from now, 3 years from now, 5 years from now, and then you estimate cash flows forever. That's a going concern. Why is that a problem? If there is a chance your company will not make it because it's distressed, it could be nationalized, terrorist attack could wipe it out, then you got to bring it in explicitly to failure risk. So ultimately, your entire valuation, the DCF spreadsheet, those are the only 5 inputs. Everything else kind of revolves around those 5 inputs. Now, over the weekend, quite a few of you emailed me and told me you didn't like your value. And I said, okay, but it's coming from your growth, your margins, your sales to capital, and your cost to capital. So if you don't like your value, one of those things has to change. So, I mean, it sounds heartless because I think you're expecting there is really no insight, right? It's your drivers of value that affect it. So when you get too low a value, it's because one of those inputs is essentially a number that you don't like. So those are the drivers of value. And early on, we talked about, hey, you can make whatever assumptions you want about each of the inputs, but your valuation has to be internally consistent. Consistency is what you can check for. What does that mean? You want to assume a high growth rate. It's your company, your story. As long as you're not making your company bigger than the market, I'll go along, but I want to see that you're putting in enough money into capacity to deliver that growth. That's basic. It's basic math, basic economics. This is not some valuation nitpicking. Without the capacity, you can't deliver. If you talk about high growth and high margins, a company improving it, I'm going to push back and say that's a great story, but where's all the competition here? Because if you're growing, you're getting market share, usually you have to cut prices. So you must have some competitive advantages. So essentially in every part of the story, I'm looking for whether you've made trade-offs. Business is full of trade-offs. And one of the things that I think takes valuations off the tracks is when you pick one input and just move it up and down as if you're in complete control. Now, I talked about how when something lowers your cost, your first instinct is, I'm going to give the company higher margins. What's the question you need to ask before you give them higher margins? Are your costs and only your costs lowered, or everybody's costs lowered? This is why I don't buy the AI pitch, which is if AI comes along, everybody's going to get more profitable. I'll make a prediction. AI comes along, we're all going to get less profitable because if it brings down a cost structure as you promise it will, everybody's going to cut prices. Nobody's going to walk away with higher margins. So think through trade-offs. So I looked at your choices, and remember, I didn't restrict you in picking companies. Other people could have picked the same company. I don't know what it is about this stupid Lululemon. Every single semester, it's up there. Okay? I don't know whether it's you like their clothes or you hate their clothes. It's Lululemon, Lululemon. You think that this is the biggest, most dominant company in the world. And it should. NVIDIA made it to the top list this year, which it hasn't before. So it tells you something about, and we'll talk about what it is that when you picked a company, remember you didn't do it randomly, right? You picked it based on something. My guess is you have a lot of momentum companies in your portfolio because they caught your attention, right? The company's up 50%. I want to see what's going on. And the bunch of companies with more than, in fact, I stopped at 4, there are like 8 companies where 2 people did the company. Now, one question I've often been asked is, why do you allow more than one person to do a company? Because I don't care. It's not like you're going to get the same value for the company, right? You value the company. It's not like this is not an accounting class. You pick 3 companies, the balance sheet is going to look exactly the same at the time that you're done. In fact, take Lululemon, that much sought after company. There are 3 companies. First, the date you did your DCF varied, because I know for some of you, there was this question. First quarter reports are just starting to come out. And I got at least a couple of emails last week asking, a first quarter report just came out. Do I need to update the numbers? And I said, you don't need to. I'm not going to penalize you in terms of points, but if you're going to put real money behind the buy on May 8th, you might want to update the numbers because it's not like you have the luxury of saying, I'll buy as of March 31st. How do you know what that means? I can't go back in time. You buy as of right now. Yeah. So evaluation. But then you can reflect this. You can see the price per share is different depending on the date you did the valuation. The DCF values are different as well. All three did come to the same conclusion, which is the stock is overvalued. You should sell it. That's not always been the case. I mean, one semester, I think that this was a particular group that I was particularly worried about because the biggest picks were, I think, Krispy Kreme donuts, Netflix. It was almost like they were sitting in their couches, eating donuts, watching Netflix. Saying, I haven't picked a company yet. What should I do? You could see it roll out. Like 11 people picked Netflix, 7 Krispy Kreme donuts. I remember what the third one was. Tinder was publicly traded. That might have shown up on the list as well, but it wasn't, I would think. It's almost like you can see people picking, it's what I use. Why don't I do it? So it doesn't, so the fact that you pick the same company doesn't mean you pick the same pathways. Look at the divergent. And the younger the company, the more divergent your stories will become. So if 10 people pick Tesla, which my undergraduate class, 10 people pick Tesla, very different end games because the stories they tell about Tesla can. So the earlier in the life cycle you catch a company, the more divergent the values are going to be because you pick different storylines. So here's what you found. So what I did was I took your DCF value, I compared it to your stock price. So currency is not an issue, right? Whatever currency you're in, it's the same currency across the board. Now the greens are your undervalued, the reds are your overvalued. 36 of your companies were undervalued, 71 were overvalued. This semester, I see more of a tilt to overvalue than probably any semester for about 10 years or so. So far more overvalued companies. The median company was overvalued by about 19%. So from a DCF perspective, you were finding a lot more overvalued than undervalued companies. And here was the list of the most undervalued companies according to you. Okay? I've left the capital letters because I remember when I first started texting, my daughter made this big deal about capital means you're screaming. And so maybe this is screaming buy and you want to say, look, I like this guy. Or maybe you just hit the caps lock button on your keyboard and forgot all about it. But I didn't want to play put some editorial comment here. So I left the caps as caps and the non-caps as caps. So these are your most undervalued. And I'm defining undervalued as a percentage difference. So basically the price relative to the DCF value. So most undervalued company, according to you, is Upwork, undervalued by about 75%. You can go down the list. Okay? You're saying what happened in Aviana? I think that the person doing it made the value and the pricing, but they either couldn't make up their mind about buy or sell, or they forgot there was a row out there. But again, I don't want to play editorial here. I just left it as a blank because that too tells me something about where you are in the investment process, right? I'm here, but I have no idea what to do. So I leave it blank. So if you're Aviana Healthcare, please go on and fill in your buy, sell, or hold. My guess is you just forgot. It's late at night. You got the numbers that in there. Of the most undervalued, 9 were by PNC. Is it the person who did PNC in here? Why did you hold? Because I have a story, but I think I understand it. But why don't you tell the class why, in spite of finding it undervalued, you hold it?
Macroeconomic environment is what's happening for the next couple of years.
And I would add one more thing. Can a valuable bank become worth nothing in a week?
Yes.
Okay. What has to happen? Your deposits leave, right? With a bank, that's always your worry. It's sticky deposits. So one of the things I wrote about in banking is what drives the value of a bank is how sticky your deposits are. What determines stickiness of deposits? Sorry, what?
Confidence in the bank.
One is confidence in the bank, but that's we're moving in circles, right? So then ask what determines confidence. You say so I need something more tangible. Yes, Ed.
Correlation of depositors.
One is to the degree that you have homogeneous depositors, you have less sticky deposits than heterogeneous deposits. Think of what's made Silicon Valley Bank's deposits so sensitive. It catered to Silicon Valley. These people not just hang out together, they're virally connected. So when one leaves, they take the entire crowd with them. So you look at diversity of deposit. Regional banks are more likely to have deposit runs than national banks because you're in a particular region, people panic. They see lines outside a bank and other people join in. It's also going to be driven by growth. Growing banks will have less sticky deposits. Why? Because it's like, you've seen cohort analysis that if somebody stays on a service for longer, they're more likely. I mean, we do this with user-based companies all the time, or subscriber-based companies, that somebody's been with Uber for 10 years is more likely to continue with Uber than somebody just joined last year. Fast-growing banks, you like the growth, but they also come with less sticky deposits. So I understand PNC Bank could look undervalued, but he's saying, can I pull the trigger? Because who knows what can happen. Yesterday, I did pull the trigger on Citi, where I bought Citi. Citi trades at a half of book value. It has below average returns in equity. It's well below its cost of equity. I did an intrinsic valuation of pricing, and I said I'm buying Citi. With Citi, I'm less concerned than I am with a regional bank. It's a national bank. It's a boring, stodgy, badly run bank. But it's priced to be an even worse, a boring, horrifically run bank. And if you can buy a bank that's badly run and it's priced as it's horrifically run, you're getting a bargain. But with banks, I can understand if you find a regional bank to be undervalued, I can understand the reluctance of saying, look, I think it's undervalued, but who knows? You're one rumor away from the whole thing unraveling. Here are most overvalued stocks. Somebody really hates the New York Times. So the person who did the New York Times here, what is the story that is driving the New York Times towards zero here? That has to be a pretty depressing story about a newspaper, right? I can think of, I'm not saying it's implausible. There are plausible stories you can tell about how newspapers are heading to oblivion. So is the person who did New York Times willing to tell me their story for the New York Times that's driving the value to $1.72? No, you won't. So I'll fill in your story. Here's the story. Ultimately, the old way in which newspapers did, which is through circulation advertising, is breaking down, right? Online advertising is coming in. In fact, you see this with most traditional newspapers. What's allowed the New York Times to stay above the fray? What have they done? They've actually one of the few newspaper companies, and you can in fact contrast the New York Times with the Washington Post to see what the New York Times has done. They've actually created not just a digital version, but they've created a digital version with stickiness. Right? If any of you use the New York Times cooking app, it's a standalone app, and as you go through and you collect things, that app collects you. So if the only way you can cook is with a New York Times recipe, you're not ever stopping a subscription to the New York Times. They bought Wordle, the gaming, because they realize a lot of people buy the New York Times not to read the news, but to do the crossword. I know it sounds weird, but they've essentially, but you can see that one of the few newspapers that's done something, but in the story that's being told here, all of that comes to naught because the digital version. So it's a plausible story, but the most overvalued. And you can go down the list, and essentially, again, the percentage overvaluation is captured by how much overvalued. Again, bunch of cells with a lot of shouted cells as well. 4 shouted cells, 7 subtle cells, but they're all cells as well. Okay. Now, of course, this has been going on for as long as I've been teaching the class. So one of the things I go back in time every few years and do is I look at recommendations made in previous semesters and I track them. It's as much a measure of the class as it is of you, right? Because is this whole class random with the buy sells? So the spring 95, 97, 99. I've got to allow enough time, right? I cannot do it with the 2020 class because the essence of intrinsic valuation is to wait. I'll tell you what I found. If you look across the years,
On average, there is no, it's beyond. So this might sound like you beat randomness. Randomness would be 50-50 shots. About 60% of buy recommendations go up and only 45% go down. It's not 100 and 0. So it's not perfect, obviously, and we know that already. When you look at across companies, the excess returns of buy recommendations on small companies tends to be a much better track record than recommendations on large cap companies. The payoffs are very skewed. In other words, when you look at a portfolio of buys and you look at why they outperform the market, and they historically have, it's because of one or two big winners.
And this is true for equity investing in general. There's this study by a guy called Bessembinder, I think he's at the University of Arizona. And what he did was he went back and looked at stock returns over the last 80 years. And he looked at what your returns would have looked like if you took the top 10 stocks out of every year. You'd have made less than the T-bill rate if you took the top 10 stocks out of every year. Now, you can look at it and say, that's why I pick stocks. But you can also look and say, that's why I don't pick stocks. Do you see why it can justify both? You can say, that's why I pick stocks, because I am good at finding those top 10. But you can see the downside of picking stocks. When you pick stocks and those 10 never make it, you're going to always not just underperform the market, you could dramatically underperform the market. Give the example of the last decade, right? If your portfolio did not include the FANG stocks, Facebook, Amazon, Netflix, Google, Apple, and Microsoft, I don't see how you could have beaten the market the last decade. It would have been impossible to beat the market. Why? Because they accounted for 1 in 6, in terms of market cap added for the last decade. Those 6 stocks accounted for 16% of the gain in market cap of the 7,500 companies in the market. The lesson I think you take out of this is those winners are what's driving the portfolio. Now, for whatever reason, I don't think this has ever happened before. My name came up in the Berkshire Hathaway, and I got like 1,000 text messages. It came up in a good way and a bad way. Some guy got up and he asked a question about the fact that Berkshire Hathaway's portfolio is now 40-something% in Apple, right? It's now because of, and he asked, I don't know why he brought up my name in this context. He said, but this way somebody else can get insulted, I guess. He said, Damodaran says you shouldn't have this much. And Charlie Munger, no, I don't think even knew who I was. He basically said I was out of my mind, I think is what the words he used. But this is a debate worth having about concentration and diversification. If in fact, the counter I would have had, and if I'd been at the meeting and I don't plan to be there, is that, Charlie, would you ever be okay with me taking 40% of my portfolio and buying a company? The answer is probably, no, that's crazy. But how did Apple get to be 40% plus of Berkshire Hathaway's portfolio? It did much better than the other stocks. So the question is, when a company rises in your portfolio because it's been a really big winner, should you then be okay with it becoming 40%? I don't think so. But you can see that the arguments here are subtle, because you can say, that's my big winner. And if I start pruning it, then how will I make returns over the long? If you think about how a portfolio company gets to be 40%, it's because you've increased the value tenfold. I mean, I look at my portfolio, my biggest single holding is Nike. Weird, right? It is an investment I made 17 years ago of $10,000. It's kind of grown over time. It's not quite got to a point where I have to prune it to be, because it's not 15% of my portfolio. But sometimes when companies rise over time, you are going to see them get bigger. But for them to become a large portion of the portfolio, they're going to be outperforming everything else. But it's a debate worth having about what to do with the winners in your portfolio. Finally, stocks that were undervalued on both a DCF and a pricing basis did better than stocks that were both just undervalued on one basis. I know, often people make you choose. Are you a believer in intrinsic valuation, or do you do pricing? My response is, why should I pick? My first instinct is to do intrinsic valuation, but that doesn't mean I should also do pricing. Yesterday, when I valued Citigroup, I started with an intrinsic valuation. I came up with a value of 69, the stock's at 43.
And I said, I want to buy. Then I did a pricing. Why? Because then I get a double whammy, right? Two things moving in my favor. All I need is traders to jump on and push the price to book up, and I'm going to benefit. So, yes.
What is the intuition behind if pricing and intrinsic values are correlated, therefore there'll be a...
It's not that they're correlated, but remember, for you to make money on your valuation, what has to happen? There's got to be a correction. There's got to be a correction, right? So what you're saying is if a stock is both underpriced and undervalued, you've increased the odds of that correction, because when something is underpriced, remember, for valuation, you're saying nobody else is doing intrinsic valuation. How will they ever know? With pricing, now you have a second force that might cause traders to adjust.
So could you say that something that is undervalued but priced appropriately will take a longer time?
Exactly. It's a catalyst moment, because then people are going to feel, okay, it looks okay price. So why are you making such a big deal? So I think that's what you're hoping for, because you need that catalyst to make money on value. And to be pricing can provide that catalyst, because I need traders coming around to my point of view to make money on a stock. Right? Now, there was one final piece of the value, the last session that I did not get to, which is the value of control. And I talked about how the value of control comes from the fact that you can run a company better than the existing people can. In a sense, when I asked you to do a valuation, I didn't ask you to value control. But let's say I'd added that as something to do on the project. You know what you'd have to do then, right? You have to take your valuation and say, what if somebody else ran the company? And it releases you to change some of the key inputs about how they fund the company, how much they reinvest, how well they go. So it's almost like you'll have a revenue growth margin and sales to capital ratio with a different person running the company, delivering a different value. Of course, to do all of this, you got to be able to change the way the company's run. And I said, for that, you're looking at the corporate governance of the company, voting shares versus non-voting shares. In a Facebook, there's really no point doing a what if this changes, what if that changes, because Mark Zuckerberg is firmly in control. So let's talk about about the issues that drive the expected value of control. As I said, corporate governance laws affect it, obviously, as they change over time. Many emerging markets, corporate governance laws have moved in favor of shareholders. It doesn't mean shareholders have a lot more power, but they have a chance at least of doing it. It could also come from the presence of activist investors. There was a time when activist investors were restricted to the US. Now you see them in Japan. There's a point where activist investors in Japan were essentially not even allowed into annual meetings. Now you see them show in other parts of the world. Essentially, they're rocking the boat. And finally, as I said, if you see one hostile acquisition in a sector, it's amazing how quickly the entire sector's expected that. So some of the things you look at to decide whether there's a chance of changing management, you're going to look at stock price performance. Companies that have done worse relative to the market are more likely to see change than stocks that have done well. You're going to also look at the structure of the board, who owns shares. With institutional investors, looks like there's a greater chance of control. But all of these go into your assessment of, is there a chance that the management of my company could change? Some of you are managing badly, valuing badly managed companies. And I think in the back of your head, the question you're asking is, this is a badly managed company. They're taking projects that make less than the cost of capital. They're continuing to do it in a sense in perpetuity, but what's going to cause it to change? And if you decide to go that route, then of course the value of control comes in. So I'm going to talk about 4 contexts where this expected value of control comes into play. The most obvious one is when you think of a hostile acquisition. What does the word hostile have as an undercurrent? What do you say? That you don't like the management of the company, you don't like the way it's run, you're going to change it, right? That's the subtext, okay? As opposed to a friendly acquisition. You're essentially saying, I think control in this company is worth something because I can run the company better. I'm going to argue that even when there's no acquisition, when you buy shares in a publicly traded company, you're paying an expected value for control. Let's say you take a company that's badly managed and badly run now, right? But you're in a market where there's a chance that things could change. A car like ICANN could come in and push for change. That's got to be built into the price, right? And the greater the likelihood that an ICANN will show up, the more the price you will pay. In other words, you're paying a premium over your status quo value. Why? Because you think change will make the company more valuable. It could be a company with voting and non-voting shares. So I said this used to be par for the course in Latin America. We had preferred shares and common shares. But around the world, there are still companies with two classes of shares. We know intuitively which class should trade for a higher price. The voting shares should trade. But the way people come up with that premium is almost arbitrary. They look at studies, say 8% premium based on historical studies. It's like the 20% control premium. I'm going to argue that the expected value of control can give you a way of estimating the premium on voting shares. And finally, in private companies or private businesses, let's say you're acquiring a stake in a private business. And I give you two stakes. One is a 51% stake in that business. The other is a 49% stake. Just a 2% difference, right? You will pay far more often for the 51% share than the 49% share. Why it's called a minority discount? Basically, that you're discounting the second stake because you get a minority ownership of the company. You don't get to say in how the business is run. We'll talk about how to attach a value to that discount. So let's start with a hostile acquisition. I'm going to go back and use Blockbuster as my example because we had two values, right? If you remember, one value was $5 and I think, $5 and something cents. The other was $12.47 per share. Let's say you're an acquirer and that you plan to acquire Blockbuster. You're tired of waiting for the managers to do the right thing. So if you think about the difference here, it's the stock was actually trading at $9.50. So we'll talk about why it wasn't trading at the low. It's trading at $9.50. As an acquirer, you might say, look, the value, if I fix it, is $12.47. There's a $2.97 extra value. Would you pay that as your premium in an acquisition? Lisa, if you paid the $12.47, what essentially have you done?
Given the current stockholders the value of the work of them
that you're going to do, right? In a sense, it's unfair. So if you're going to value control, first step is how much of that value do I keep for myself? This is not a number you're just going to pay as a premium because otherwise all your hard work comes to naught. If, let's say it'll take you 3 years to make this change, how would you modify the premium? First, would the premium go down or go up if you have to wait 3 years? It's going to go down. The more difficult it gets made for you to make those changes. And the present value effect is really all that's happening. It's $2.97 being discounted. So in hostile acquisitions, the value of control is always at play. Which means if you're assessing a hostile acquisition, you have no choice but to value the company twice. There is no way around that process. You're saying, but what if I'm not looking at the company as a hostile acquisition? Let's go back to Blockbuster. Let's take the hostile acquisition off the table, right? Remember I told you the stock price was $9.50? Let's say you trust my two valuations. I mean, I made assumptions. My two valuations were $5.13 was the status quo value and $12.47 was my optimal value. Could you estimate a probability that change will come to the company? You solve for it. Turns out the probability of change coming to the company is 59.5%. But this was after Carl Icahn showed up at the company. Before he showed up, the stock price was only $8.20, and that attached. So you're saying what happened? Very simply, when an activist investor shows up at a badly managed company, it's not that the status quo value, the optimal value are changing, but the probability of change is increasing. And as it moves further up, you're going to see the stock price drift towards $12.47. Now do you see why, if you live in a market where corporate governance is dead, market prices are going to be lower? Because every company then goes straight to the status quo value. Ed?
You read the UK equity market, London Stock Exchange, and thinking of removing lots of their governance protections. So they're now going to be allowed to have dual class shares, and they're not less supported in accounts.
Yeah.
But I guess what you're saying here is over time that's going to result in a less.
Yeah, because in a sense, if I make it more difficult for change to come, investors are not basically going to go back to status quo value. This used to be true in many emerging markets. We're reinventing history. And it's not just the UK. Look at the US, where you've got two classes of shares. You're essentially moving in the wrong direction. Across the board, we now risk pushing prices down towards status quo value and making change impossible at these companies. Now, so when you look at the value of stock in a publicly traded company, it's essentially a weighted average of the status quo value. So if markets are, even markets are efficient, and the optimal value with the weights based upon the likelihood of change coming. So it's a very simple way of assessing how strong is corporate governance in the market is to look where between those two values you end up. I'll wager if you look at the technology companies that have gone public over the last 12 years, almost all the prices have to stay at the status quo value. There is really almost no chance of outsiders pushing for change in these companies, whether it's Google or Facebook or any of the large companies that have essentially gone public. I think the exceptions are companies like Uber that decided not to have two classes of shares. And I've got to give Uber credit for not doing it, but they were the exceptions rather than the rule. I'll talk about voting and non-voting shares. Right? So to see how this would work, remember I said that in Latin America for the longest time, this was the rule, not the exception. The voting shares were called common shares, and the non-voting shares were called preferred shares. Preferred shares in Latin America are not like preferred shares in the US. Preferred shares in the US are more like bonds than shares. They're like, fixed coup. So preferred shares in Latin America are just non-voting shares. And as I said, we know voting shares should trade a premium. We just don't know how to get there. So I'm going to try. Here's what I did. I valued, in this case, Embraer was a company I was looking at. I valued Embraer twice. I came up with a status quo value of 12.5 billion Brazilian reais. And then I revalued it with a few things that I thought they could change and came up with 14.7 billion. You got two numbers floating around, right? And here's the game I played. I'm making some implicit assumptions that I'll make explicit in a while. I took the 12.5 billion and I divided by the total number of shares, voting and non-voting. Essentially, what am I saying? If I get a non-voting share, I'm stuck with the status quo. There's not much I can do. So essentially, your price per share or value per share should be based on the 12.5 billion. I came up with $17.38. Now, what's the advantage of a voting share? You get a say in how the companies run. Let's say there's a 20% chance that you can actually change the management of Embraer. Remember, Embraer has the Brazilian government as a shareholder with a golden share, which means that they can veto it. So the probability of change is low. Let's say there's a 20% chance. You take 20% of that difference and you divide it just by the voting shares. Why? Because only the voting shares control that change. So what you're doing is adding that to the 1738, the value per share that I get for the voting shares is $19.19. The voting shares trade at a premium, but think of what's driving the premium. First is how well managed or badly managed the companies. Let's pause right there. At well-managed companies, what should happen to the difference between voting and non-voting shares? They should go towards zero. The more badly managed companies. So this might be, if you want to do some, a research paper, you can take companies like Facebook and look at that voting to non-voting share difference over time, because clearly people's trust in Zuckerberg has varied over time. Second, it's going to depend on the probability that you can get that change. If the voting shareholders have so effectively controlled the model that change can never come, the probability goes to zero, the difference will go towards zero. And it'll also depend on how many voting and non-voting shares there are outstanding, right? If I have 100 non-voting shares and only one voting share, the premium on the voting share is going to be much higher because now I'm taking that expected value of control. Now, there are some Canadian companies with voting and non-voting shares. These are closely held companies where the owner is 3 or 5 shares, but those are the only voting shares, and there are thousands and thousands of outstanding shares. And this comes up in Canadian courts all the time because those voting shares can trade at 50 times the price of the non-voting shares because you're loading up all of that expected value of control into a few shares. So if you run into a company with voting and non-voting shares, you can always use the shortcuts. Say, I'm valuing the share, I'm going to attach a higher number to the voting shares. But if you really want to dig deeper and say, why would the voting shares be trading at a premium? You got to go through the process of valuing the company with the change put in. Which brings me to my final point about minority discounts. Let's say you're valuing a private company. You have two values for it, 1.6 million with the existing management, 2 million with you in place. And then I ask you, how much will the minority discount at this company be? In other words, how much less would you pay if you got 49% of the company? You get 51% of the firm, you're willing to pay up to 51% of the optimal value. Why? Because you run the firm, you can change it to the 2 million. You get 1.02 million. You take a 49% stake in the same firm, you're going to pay 49% of the status quo value. Look at that 2% difference in how much it translates into. Again, the better run a private business, the smaller the minority discount should be. If anybody offers you 49% of the Madison Square Garden, demand a hefty discount, because as long as the Dolans run it, it's a horrifically run business, right? Same reason, if you were offered to be a minority owner of the Mets when the Wilpons ran it, you'd pay a very low value, right? So when you think about minority shares and how much you discount them, it's going to depend on the perception you have of the management of the company and how much you think they add to the value or take away from the value. So expected value of control is not just for, hostile acquisitions. It shows up all the time. I have an extended paper on the value of control if you're interested in kind of digging into the probability of change coming, because there are lots of different pieces in play. Which brings me to the final point I want to make about the intrinsic valuation section. When you think about a DCF, lots of moving parts, right? Imagine trying to explain your DCF model to a CEO. After about the second input, he's going to lose patience. He says, look, I don't have the time for this. I have a lot of meetings lined up. Could you give me one metric? And this is a boon for consultants. Because over the decades, consultants have taken value, which comes from lots of different inputs, and said, this is the one number that matters. Let me give you a metric. And usually they concoct that metric, and it almost always becomes an acronym. I'll give you two acronyms that in the last century caught consulting companies and was sold by consulting companies. One was this notion called CFROI, cash flow return on investment. You know how we compute return on invested capital, right? We take operating income divided by invested capital. What's the first pushback? Yeah, it's earnings. I'd like a cash flow. So CFROI fixes the earnings by replacing with cash flows. And second, the second thing you worry about with return on capital is there's no time value attached, which is you weight in earnings you'll make in the future years and current years equally. CFROI does it. It's like an IRR for a company. And Holt Associates, is a Chicago-based outfit, sold it as the magic bullet, right? If you're a company and you increase your CFROI, your value will go up. And then in the 1990s, there was an outfit called Stern Stewart, New York-based consulting firm, that concocted a measure called economic value added that they said was the greatest measure ever. I'll tell you what economic value added, and you tell me whether you think this is a great measure. They take the return on capital, same return on capital we talked about. They subtract out the cost of capital. And here's their first stop. They say it's good to have a return on capital higher than the cost of capital. So, oh my God, that's an incredible answer. Okay. And then they multiplied by capital invested. Why are they trying to do it? They're saying it's good to make a higher excess return on $1 billion than on $10 million. What insane insights these are. But CEOs lapped it up. It was the fastest growing metric in use in companies. Half the S&P 500 at one point in time in the 1990s adopted it. The sales pitch was, this is amazing. It'll change the way you think about value. In fact, they would use words that would drive me crazy. You'd get a better valuation of a company if you use EVA or CFROI than if you did a discounted cash flow valuation. It's an absolute lie. Because all that EVA does, what do we do in traditional discounted cash flow valuation? Predict the total free cash for the firm, we discount back at the cost of capital, right? Here's what EVA does. It takes that free cash for the firm and divides it into two pieces. One is the portion of the free cash flow that gets you to the cost of capital. And then the rest as an excess cash flow. It discounts the two separately and it adds them up at the end. The nature of present value is it's additive. I can divide the cash flows into 5 pieces. I'm going to get the same value. There is, in fact, you can prove that if you value a company with EVA, CFROI, and DCF, you get exactly the same value. But the point is, it was sold as this magic bullet. All you need to do as a CEO then is to focus on your EVA, and everything else will get taken care of. It's a shortcut. You know the problem with shortcuts is? That you're making a lot of implicit assumptions that people are now going to exploit to game the system. So here's what I want you to do. Yeah, your company's adopted EVA. And here's the other thing Stearns Stewart did that was really clever. They tied CEO compensation to higher EVA. So you increase your EVA, you'd get a bonus, additional options. So let's say your EVA this year is $500 million. Tell me some of the dysfunctional ways you can increase EVA next year that'll deliver the bonus for you while making your, I know this is, it's perverse. I want you to think about ways in which you can increase EVA that could make your company actually a less valuable company over time. It's just operating income, right? Can I increase my operating income next year by doing some short-term stuff? That absolutely. EVA encourages, basically, if I judge you based on EVA, I'm encouraging you to go for short-term investments that pay off as higher operating income in the near term over long-term investments that might be better for my company. Doesn't matter what goes into invested capital. Early on, when EVA was computed, people did not capitalize leases and include invested capital. You know what made your EVA look much better? Instead of buying an asset, you leased it. You took it out of the books. You're saying, but why are you assuming that over time, if your compensation is tied to bad stuff, you will do bad stuff. And that's exactly what happened with EVA. And just to close that discussion of EVA, the two guys who founded EVA were Joel Stern and Bennett Stewart. And Bennett Stewart could sell refrigerators to Eskimos. His finance knowledge was about as shallow as you can get. But he was a great salesperson. So I remember being on a panel with him and, in front of European CEOs at that time. He was talking about value enhancement. He got up and he held up an annual report for Coca-Cola. He said, Coca-Cola uses EVA. And that time, remember, Coca-Cola was soaring success. Coca-Cola has doubled its market cap. Took in logic classes in school. Hey, it's a BB. So you want to be like Coca-Cola, you should adopt EVA. I almost, at that time I was steaming. I was, nothing I could do. So next time, I knew I was going to run into him in some other panel somewhere in the city. I came with my Air Jordans. At that time, the first Nike had just released the Air Jordans, Michael Jordans. And I came, so I came to the panel with tennis shoes or basketball shoes. So he made his pitch, and after he was done, I took my time, I took off my shoes, I put on the Air Jordans, and I said, could somebody point me towards a basketball hoop? I've got my Air Jordans on. I ate my Wheaties. I remember that Michael Jordan probably had Wheaties that morning as well, according to the ads. I said, I feel like slam dunking the basketball. I'll have to tell you something about my leaping ability. It's like 6 inches off the ground. The only basketball hoop I can do a slam dunk are those Fisher-Price hoops. I can wear all of the Air Jordans I want, eat all the Wheaties I want. I will not slam. So my point is, just because Coca-Cola did not become successful because it adopted EVA. EVA is just a metric that basically tracked its success. None of these consulting firm built metrics are going to make you more or less valuable. Creating value is hard work. You got to take better projects, you got to fund them better. But the shortcuts keep coming at us, and they are part of gaming the system. So let's talk about pricing your company. Remember that 4-step process we went through on pricing, deconstruct? Start by defining the multiple. Make sure your multiple is consistently defined, uniformly estimated. Second, describe the multiple. Look at the histogram. Look at the data. Don't use rules of thumb. We have the data in front of us. Analyze the multiple. If you have an equity multiple, go back to a dividend discount model or an equity valuation model, do the algebra, and you can tell me what variables drive that multiple. If it's an enterprise value multiple, go back to an enterprise value multiple and do the same. And only then apply the multiple. Define, describe, analyze, apply. And I said, the problem in pricing is people are in a hurry to do pricing. They want to be sloppy. They want to use averages. I don't have a problem with pricing, but after your exercises with pricing, you can see this is an exercise in data analysis and statistics and using the data better to get a better pricing for your company. So let's, let me review, based on the multiple, what variables you should be controlling for. This is just based on a pure discounted cash flow model. You tell me what your multiple is, and I said, these are the 4 variables. These are the 3 variables you should focus on. Price earnings, it's growth, payout, cost of equity. EV to sales, it's operating margin, return on capital. Essentially, with each one, list out the variables. Those are the variables you want to control for when you look across that multiple. So I asked you to pick a multiple, and here's what you picked. Almost half, I mean, in this class, half of you picked EV. Do you see why you keep climbing to EV to sales? What's the nice thing about pricing things relative to sales? Jackie?
There's no negative.
First is, if you have a money-losing company, but even for money-making companies, it turns out that sales is the least accounting contaminated number you can get. So I understand. Now, that statistic, that pie chart, if I showed you from 20 years ago, you'd have seen about 25% of companies using PE ratios. Increasingly over time, equity multiples have become a smaller and smaller slice of use. And you probably saw that even as you tried out, that you ended up with enterprise value multiples. So half EV to sales, EV to invested capital, EV to EBITDA. There was one person I think used EV to EBIT, PE ratio, and price to book ratios. So in terms of equity multiples, 9 plus 8, 17% of your companies used equity multiples. And my guess is a few of those are banks. You had no choice but to use an equity multiple. Because of the bank, there's no such thing as an enterprise value or an enterprise value multiple. And here's what you found on your pricing relative to your DCF. So I took your DCF value and I took your pricing to see what, and you're probably not going to give me a surprise. It's 67% of your companies. And this perhaps is surprising given your overall statistic. The DCF value was about 18% lower than your pricing, the median. I think I got these numbers reversed. It's 40%, 40 companies, the DCF value was higher, and 67, the pricing was higher. No, I'll let that kind of simmer in there as to what that means about the overall market. Because remember, in pricing, you're tending to look at what the market is doing and attaching it to your company. DCF, you're doing an intrinsic valuation. And when you looked at what you found, your median company was overvalued. Remember the DCF, you were overvalued by 10% plus. Here, the overvaluation is only about 3%. In fact, I would be surprised if it's not different from 0. You see why with pricing on average, the typical company is going to be fairly priced because by definition, if you're comparing to the rest of the market, you're going to move towards the average. And the breakdown is almost 50-50. Half the companies came out as underpriced, half were overpriced. You will never, I mean, my DCF value, you can get up with statistics like 80% of the companies are undervalued. With pricing, you're almost always going to be around 50% because of the nature of pricing. Now you see why portfolio managers like pricing. Your job is to pick stocks. You need stocks to keep showing up in your portfolio. Pricing is always going to find you cheap things because it's relative to everything else. Whereas with intrinsic valuation, you can find yourself completely bereft of companies to invest in because nothing looks cheap. Here are your most underpriced stocks, right? So you can see the percentage. The most underpriced is MTN, Nigeria. I don't even know what the second company, Academy Sports Plus Outdoors, what does it do? No, I don't know. Right. And you can work all the way down. These, you see a few big names, GameStop, Uber, Zillow, Alibaba, a lot of younger tech companies show up as. No. Part of that, so I think it depends on what sector, but they come out as underpriced relative to whatever sector. So maybe your growth is doing amazing things in your pricing because most of these companies don't make much money. But remember, growth can show up in your pricing equation, perhaps push up your equation. Here are your most overpriced stocks. Right? So the same person who didn't like the New York Times on a DCF doesn't like it on a pricing as well. So it's showing up as overpriced. Now, but you can look across, tobacco, Philip Morris shows up as overpriced, which by a huge amount, which is surprising given the fact that it's kind of a mature, kind of boring company. But those are your most overpriced stocks. I did ask you to try an option pricing model, but what are the 2 things I said you should look for to see if it works for you? One is it has to be money losing. Don't do this in a money making company. Others, there's a lot of debt. This is an option to liquidate. That's why for a growth company, it's kind of pointless even opening this box, because the option to liquidate a growth company is going to give you a number much, much lower than a DCF valuation. So this is reserved for probably mature companies, declining companies. The question you're asking is, is there a chance that I could make money if the value kind of bounces back above that outstanding debt? And I know a few of you are valuing casinos. I know who is valuing MGM. Somebody was valuing MGM. They're having trouble getting the value of the discounted cash flow valuation to be positive. Why? Because the business is squeezed. They have a lot of debt outstanding. The casino business is getting squeezed, and they couldn't get the DCF value. Only way you get any number there is to think of MGM as an option where you hope that something good will happen to the casino business and perhaps pay off.
In the previous slide, like one of the zero, what does it mean when you have DCF value?
It just means that you can't get the operating assets greater than the outstanding debt, right? In fact, in the other class, there are at least 15 companies with the DCF value was negative, right? But ultimately, a negative value doesn't make sense because you don't pay a negative price. So the value goes below zero. You're basically putting up your hand saying, I would pay for the equity in the company. The business is just not worth it.
There's one person in the other class who actually spent almost the entire semester trying to get the value for AMC above zero. And finally, I said, at some point, you got to just give up, right? You can try a higher revenue growth, but basically the question you're asking is the theater business valuable enough that I can cover the debt? And your answer might be, no, I don't see it. So it's entirely rational. It attaches zero value to a company where there is significant debt outstanding. But those are exactly the companies the option pricing model might kick in. With AMC, what's the optionality? Do people still go to movie theaters? Yeah, right. In fact, you could argue that a Disney needs AMC more than AMC needs AMC, right? Because if you take AMC out of the mix, Disney becomes like any other company. They'll go directly to streaming. One of the big things about being a movie company is having that outlet. So maybe one of those companies might step in and say, I'm surprised it hasn't happened already, to be quite honest. That an Amazon or a Disney has not snapped up AMC at its current market cap because it could be worth a lot more. That's the optionality you're hoping for. So even though the DCF value is zero because they're operating at, you're saying there could be this jump in value if somebody else found a different way to run the theater business. And there were, I think, 8 companies where the option pricing model was used in this class. And on average, they created a premium of about 41% over your DCF value. That's the allure of optionality, is you're paying that premium over the DCF value. So what is the final part of your project? I wanted you to tell me whether you would buy. This is why along the way, when people said, should I run 3 regressions? Should I run 5? My response was, do whatever you need to do to make a decision, right? If you need 5 regressions to get there, run them. But this is about converging on that final decision. I try to do buy or sell, but a lot of you did go with hold, which is kind of chicken, but it's okay. I can understand. Buy, sell, or hold. But when you got to the decision, I will wager one of 3 places. One is you're saying, I'm not sure yet. You know what? You'll never be sure. Right? Because the nature of valuation is there's always going to be something over the horizon. I constantly hear people saying, once this banking crisis is over, then maybe I'll buy a bank. Once this crisis in this country is over, then maybe I'll buy an Indian stock. You can't do that. You essentially have to accept the fact there's always something you're not going to be sure about, and be okay with that uncertainty. Second, whether you like it or not, when you buy a stock based on a valuation, do you believe in market efficiency? Eventually, yes, right? Because how do you make money? So we're all believers in market efficiency. We just have this very convenient definition of efficient markets, that markets are inefficient when we take a big position. And then what do? They become magically efficient, and we get like, it's a very selective view. So when people say, I think markets are inefficient, and that's why I invest in markets, put them on the spot and say, do you think markets are inefficient, or you just think they're not efficient yet? And once you've taken the position, they're going to become efficient. And finally, and I think this is one
reason I push back against concentration. I'm going to ask you whether you're buying this. Let's say you have the funds to actually buy, and that's an assumption. Would it make a big difference if you were taking all of your wealth and buying the stock or putting 5% in it? Yeah,
Yes.
right. In fact, if you're putting all your wealth, you'll almost never pull the trigger, right? It's too much at stake. One reason I put this requirement of no investment I ever make will ever exceed 5% of my portfolio to begin with is it actually makes it more likely that I'll make a decision. Because otherwise I have too much riding on the decision. I'm going to, on the one hand, the other hand, and the third. This, I'm buying sitting. Do I feel sure that I'll make money? Not in the least. Could Citi go to zero? Of course. Will that change my lifestyle? Not in the least again. So to the extent that my bet stays small, it allows me to make decisions on companies where I otherwise would be paralyzed. So the reason you spread your bets is to allow you to make decisions. Otherwise, you're never going to make those bets. So I asked you for your recommendation. 56% sell, 31% buy, 11% hold. What the heck is this moderate buy? What the heck does that even mean? What does the word moderate in front mean? Right? And so I would take out the moderate and pick one or the other. Don't do this buy hold. You can't do both at the same time, right? So, but this reflects the fact that you're not. This is why analysts can do stuff like this and get away with it, right? It's not their money. It's a strong buy, weak buy, moderate buy. Take the moderate, strong, weak. You either buy or you sell. And if you don't want to do either, just hold. There is no 15 other choices you can add to the mix. Okay. There are actually two in the same group. There is one person who's toxic in that group that you need to be very careful about. So, who's selling this notion of let's do things in moderation. It sounds like a good thing. Let's add a moderate. No, in investing, there is nothing moderate about what you're doing. You either buy or you sell, or you don't do anything. Just walk away, right? Now, just to give you a sense of what this buy, sell, I know it's a very tough, I want you to focus on this brown line. It's the most readable line. It's a percentage of, so basically it's a buy to sell ratio. So when that number is above 1, there are more buys than sells. So let's start in spring of 1999, it's close to 1, which means there were as many buys as sells. Spring of 2001, it had shot up to I think the highest number ever. There were 1.5 times more buys than sells. So what happened between spring of 2000, spring of 2001? The dot-com boom bust. And in a sense, all of a sudden, you start to see more buys. So you can track it over time. There's 2008. In fact, leading into 2008, the percentage of buys was pretty low. Then post-2008 pops up again. The last 2 semesters, both last year and this year, the buys to sells have become much lower. Last year would have been a good leading indicator because it suggested that bad things were coming, but who knows what this year will bring. So you can track the market over the rest of the year to see how good this statistic is as a collective indicator. One final point, if when you look at valuation versus pricing and how do I decide which one is right for me? It depends on, first, what do you value? Depends on the asset you value, how marketable it is, whether it has a capacity to generate cash flows. For God's sakes, don't waste your time valuing Bitcoin or valuing a Picasso. There's no such thing. You can price it, right? How do you price a Picasso? You look at other Picassos or Picasso-like paintings. You see what other people pay for them and you adjust the pricing. So don't waste your time trying to value things that cannot be valued because anything that doesn't have cash flows cannot be valued. Currencies can't be valued. Commodities, for the most part, can only be priced, right? So if you ask me, what's a fair value for gold? I have zero idea, but I can tell you how to price gold. And finally, it's going to depend on how unique something is. If you have a truly unique asset, you better hope it has cash flows because pricing it gets really difficult to do. In terms of what your characteristics are that will determine whether you should value a price. If you have a short time horizon, probably should be doing more pricing than valuation. Your time is not your ally. Now, if I asked you, do you have a long time? I'll wager if I go around the room, you'd all claim to have a long time horizon. Why? Because that's what we're supposed to say, right? But this is really not your choice. Some of it you were born with. Some of us are naturally more impatient than others. Some of it is thrust upon you. Your, I wouldn't have said this at the meeting, but Charlie Munger mentioned this about being concentrated. I said, look, your time horizon is not that long. Why are you 97 years old? You don't have a 20-year time horizon left. So maybe you can concentrate, because by the time Apple falls apart, you'll be dead and gone. Oh, I understand. So put half your money in Apple. So sometimes time horizons are driven by things that happen to you. You have a healthcare crisis, all of a sudden your time horizon just got shorter, right? Because you have all that money coming to you. It'll depend on why you're doing the valuation. Are you doing it to buy the company and hold it for its cash flows? You're doing it because you want to beat the market over the next year. And finally, it'll depend on what do you think about markets. How do markets make mistakes? They make mistakes that they correct over time, which is what intrinsic valuation is built on, but they make mistakes in the cross section. They're right on average, but they're wrong on individual, which is what pricing is driven by. So if you ask me which is better, valuation or pricing, I'm going to turn it back on you. So I'll tell you what works for me based on my beliefs, but you got to come up with your own choices on which one you did. So this is a question I promised I would ask you at the end of the class. I asked you the same question. Don't remember? You can go back and I think in session 2. I said at the end of the class, I'm going to ask you, at that time I described to you, you hadn't valued a company, you haven't priced your company. Now that you valued and priced your company, you don't have to give me the answer. I want you to think about which approach you would use. Or maybe you'd have concluded after trying to value and price your company, but this is a little messier and more complex than you thought it was, and this isn't for you. It's a very healthy recognition when that happens, because you know what it's going to lead to, right? You're going to put your money in index funds, going back to live the rest of your life. You live perfectly fulfilling life, so you never value another company. I know I'm not supposed to say that in a valuation class. Millions, billions of people over time have lived fulfilling lives without ever having valued a company. So you can be one of those people. Because the alternative is that you keep valuing companies and nothing good comes out of it. And then you beat yourself up because you spent all this time valuing companies and you don't have a reward. And as for start of the class, I said, look, you're going to build on your skill set and work on your weak side. And I talked about storytellers and number crunchers. So if you were a storyteller coming into this class, I hope I've given you enough comfort with the numbers like revenue growth and margins and reinvestment. You have to naturally go there that you can feel more confident about the story you're telling. Because once you reinforce your story with numbers, the story gets stronger, but also you get more discipline. You realize when you're telling fairy tales. So if you're a storyteller, I hope you've been able to develop that. Trust in numbers is too strong a word, but acceptance of numbers is something you have to talk about in business. And if you're a number cruncher, and I said this was the tougher task, I hope you feel enough confidence in your imagination that you're sometimes willing to let go. Let go of what? Where you want proofs of everything, numbers to back things up. Sometimes you just got to take a leap out there and say, I really don't know what's going to happen. I'm going to make an estimate. There's nothing that will confirm that my estimate is right. Yeah. But that takes more work. And that's why I said it's easier for storytellers to develop enough comfort with numbers to work with valuation than it is for number crunchers to let go, because you've spent a lifetime getting to where you are, right? So some very simple propositions about value, right? Every decade, I'm told that the world has changed, that the old rules don't apply. And the more I see things change and the more I see them change back, the more I'm convinced that it goes back to basics. I mean, when you talk about business, it's revenues, cash flows, growth. I mean, those things don't change just because you're in a new economy and a new kind of company. Okay? So go back to basics. And if nothing else, I hope, that's second. I mean, in your valuation, think of all the places you got stuck and then ask yourself, was it worth getting stuck at that place? There's some things you probably spent hours working over that had absolutely, I'll give you an example. I know somebody who spent at least a week, because 7% of their revenues came from the rest of the world. And they wanted to see where in the rest of the world. So they spent almost a week doing research on the rest of the world. And I didn't have the heart to say it, but my point was this is a third decimal point estimation issue in your value per share. But it takes time to recognize what numbers you should be focusing on, what numbers don't matter. That sales to capital that you took hours and hours thinking about, if you had a 3% growth rate, you know what? The sales to capital ratio is making almost no effect on your value. Why? Because your revenues are growing so little. If your revenues are growing 30%, it makes far more sense of what's the right sales to capital for your company. The reason I did not kind of make it explicit is sometimes you got to work with numbers to the point where you say, that's the number in this company that I should be focusing on. No, there's a driver. What's that driver? With Netflix, to me, it's all about content costs. That's the number that's going to determine whether Netflix is going to be worth $1 trillion or $100 billion company. Because everything else revolves around, can they get content costs under control and grow at a rate less than their revenues? Third, as you go out there, you'll be some grizzly analyst who's been working 30 years will say, trust my gut, I've been doing this for 30 years, 6 times EBITDA is cheap. And this is a business where you could be around 30 years and absolutely have no idea what you're talking about. Right? Anecdotal evidence is the worst kind of evidence here. And people still use it, right? They use the example of an individual company when in fact, we have the data to counter. We have hundreds of companies. Let's let the data guide us where to go. But keep your perspective. It's only evaluation. About 15 years ago. Now, end of one of my classes, somebody who's graduating comes up to me. And she was a history major from Yale who came back to business school. And usually if you're a history major from Yale and you come back to business school, you take the strategic route. You know what that is? Take every class with the word strategic, now sustainable in its name. You can spend 2 years without ever seeing a number. But by accident, I think she ended up in this class and she turned out to actually like it. She actually was pretty, so she came to me at the end of the class. She said, I never thought this would happen, but I have a job as a sell-side equity research analyst. I said, my condolences. No, I said, my congratulations. No. And she said, I'm really scared. And I said, what are you so scared about? She said, what if I make a mistake? I said, be glad you're not a brain surgeon. Brain surgeon makes a mistake, somebody dies on the table, right? You're an equity research analyst, you make a mistake. What happens? Somebody gets richer, somebody else gets a little poorer. Just make sure that somebody who's getting a little poorer is not you. That's the only requirement. Think like a Marxist. You move some wealth around, the world has intended, just let it go. Nothing in valuation is worth losing sleep over. I've never lost sleep for a single night in all of my life because of, did I get that valuation? It's just a valuation. It'll work its way through. And in investing, much as I'd love to tell you that it's skill and whether you understand valuation fundamentals that are going to determine how much money you make, I'd be lying. The dominant factor in investing is? It's luck. Brought home to me by my mother-in-law when she came to visit 22 years ago, right at the peak of the dot-com boom. And all she would talk about was what was in her portfolio, what was out of her portfolio, what she wished was in, and she thought I was interested, but I had to act interested. That's what son-in-laws do. And then she lets it slip that she owned Cisco, one of the great stocks of the 90s. I was impressed. I said, Judy, why do you pick Cisco? I was afraid the answer is I like that vegetable oil, or I like to dance disco, Crisco. No. She said, I don't know what they do, but no, I know they're good. Luck dominates skill in this process. So if I had a parting wish for you, be lucky. If you're superstitious, stay superstitious. If you notice your stocks go up, if you go into a particular Starbucks and you get a venti cappuccino, my advice is go into that Starbucks, move next to it if you can, move apartments, go in there every day, buy 2 venti cappuccinos if need be. Don't mess with luck because it turns against you. There goes your portfolio. Final point, and this is more for me than for you. There's this thing called a CFE. I actually wrote it 20 years ago. I wrote a very different version. You want to see the version that I wrote? No. But there is a CFE, you're supposed to fill it out. You know why I'm reminding you of doing it? Because if you don't fill your CFE as an MBA, what do you not get to see? Your grades. And when you don't get to see your grades, you know what's going to happen? You're going to email me. So this is about me preempting that process by saying, you know, just fill in the damn CFE, check your grades out. So I'm not 2 weeks from now getting an email saying, I can't see my grade. Could you send it to me? I would send it to you even if you did that, but save me the trouble. Right? That's it. And I will see you. And reminder again, final exam is day after tomorrow, so you don't have time to rest after you turn your project in. I will see you on Wednesday. And the time I think is 1:30 to 3:30. So around the time of the class.
What?
Thank you for the survey. So, for the, are you directly right? Yeah, I have lost him. I asked him to be